Lane Jones is the Chief Investment Officer at Evensky and Katz, a wealth management company in Coral Gables. And Lane, thanks a lot for joining us tonight.
Thanks.
Welcome. We keep hearing the word volatility, that possibly this is going to be the new normal on Wall Street. Do you believe that?
Oh, I think volatility will keep uptick a little bit from where it has been the last few years because it's been very, very complacent. I don't think we're likely to see the swings that we've been seeing the last week. A lot of that is exaggerated by program trading and folks that come in right at the end of the day, and these algorithms push around a lot of money along very quickly. But I don't think that this is the new normal, no.
I want to get your reaction to something that we heard today from the Treasury Secretary, Steve Mnuchin. He was asked about the market volatility. Here's what he had to say.
The stock market is up significantly, over 30% since President Trump was elected. We're monitoring the stock markets. They're functioning very well, and we continue to believe in the long-term impact of the stock market.
The markets are functioning very well. Do you agree with that?
I think generally they have been. I mean, the tax bill has been good for the economy. Overall, the economy is healthy. I think it's a little unusual that we've had markets that have sort of just gone straight up for a while. So I always sort of say 2 steps forward, 1 step back. So that's kind of normal for markets and pretty healthy.
Well, that's good to hear because there's a lot of concern out there. So before stepping down as Fed chief, Janet Yellen, she raised a flag and she said there was concern that asset valuations were so high. So is what we're witnessing now, is this a blip on the radar, or is this a sign of things to come, you think?
I don't think there's any question that markets had gotten a little expensive. At least the U.S. stock market had gotten expensive. Just alone in January, the market was up 7.5%. So what we've really done is given back almost just a month's gains. So I think it's normal that when markets get a little expensive and healthy, that they start to revert back a little bit. And I think we'll probably start to grind higher as profits come in good. The economy is underlying pretty healthy.
But what about the concern about rising interest rates? Employment is tight right now. The jobs report showed that there aren't as many people out there looking for jobs, so companies are competing for workers, and a concern about inflation. What about all that?
Yeah, that's the match that sort of lit this fire, which is, it's sort of counterintuitive. When you have good economic news, the fear is that interest rates will rise. In fact, they had risen about 0.5% in just the last 6 weeks, and ultimately people get addicted to this cheap money, and maybe that party is starting to end, and it's taking a little bit of the steam out of things.
Only about half of us are invested in the stock market nationwide. So what do you say to your clients who do have money in the markets and who are a little bit nervous about what they're seeing these days? What's your advice?
Well, ultimately, you earn returns in markets for taking risk. And it's days like this that prove that roller coaster is what you have to ride in order to ultimately get where you're going. I generally say you don't put up the shutters when the storm is overhead, so you got to kind of just ride this out. But it is always a good thing to sort of evaluate what kind of risk you're taking in your portfolio and whether that roller coaster is maybe a little too bumpy.
And I was asking you about this earlier during the commercial break, but what does it mean if the interest rate is going up, which people are projecting it is? What does that mean for people now trying to buy homes, trying to sell homes, whether they're in the market in real estate?
Rates rising just generally makes buying real estate more expensive. So it's a little harder. Your loan costs a little more, your mortgage costs a little more. So it does take a little steam out of the real estate market. Ultimately, rates are still very, very low historically, but relative to maybe where they were, 6 weeks ago, real estate has come down a little bit and maybe has some room to go further.
But are you seeing clients take their money out of the stock market and maybe put it in real estate?
No, I'm not. I think generally we're seeing people stand pat. I don't think, like I said, you do things when there's a crisis sort of overhead. But over the years, as rates have been pretty low, certainly people have been making investments in real estate, and that's why real estate has risen so well.
So let's talk about what people's portfolios, and if you have a 401k, as a lot of people do, chances are you're invested in the market in one way or another. First of all, your advice not to look at your 401k this week. Don't even go there. Don't even take a look because it's not going to look good.
Yeah, as long as you're diversified, I would sort of not panic. If you're in individual stocks, then, certainly individual companies can go through problems that are different than the world economy. But on the whole, the market over time has a 100% rate of recovery. It has never not recovered. It might take some time, but generally speaking, as long as you're diversified and in the world economy, and that's what you own, I would stick with it.
But that's important for older investors who may need to get to those funds a little sooner than younger investors would. It's a whole different calculation, right?
Yeah, absolutely. If you need money in the next 12, 24 months, and you're going to need it, it really has no business being in the stock market anyways. It's sort of a coin flip whether you'll have more or less when the time comes that you need it. So I wouldn't necessarily make changes right now, but certainly when things settle down a bit, I would evaluate, do I have the money that I'm going to need to buy groceries already set aside?
Really quickly, for people who are not invested in the stock market, is this a good time to jump in now that it's
I don't think the market is really cheap. You know, I mean, I do like buying at a discount, but I would probably follow a program that does regularly purchases into the market. I wouldn't say that right now it's dirt cheap and just throw it back up the truck.
So stand by and watch for the time being. All right.
Lane Jones, thanks very much. Lane is Chief Investment Officer at Evensky and Katz, Foldis, a wealth management company in Coral Gables. Nice to meet you. Thanks for coming in.
Thank you.
Thank you.
Thank you, Lane.